Hi guys, welcome back to the channel. My name is Brad. This is the Firefighter's Financial Toolbox, where we talk about investing, retirement, taxes, and all the things you need to know to help you become financially free. Okay, so there's a new tax proposal out there brought to you by Senator Ron Wyden, who is the chairman of the Senate Finance Committee, and what he wants to do, I'll read the title. Democratic plan would close tax breaks on exchange-traded funds. Now, you guys, you know I don't like to get political on this channel, but this is going to have a big effect. As you guys know, the big tax benefit of holding ETFs in a taxable account is that because, unlike actively managed mutual fund, when it sells a security, they do an in-kind transfer. So rather than selling the security into cash, buying a new one, which would cause a capital gain, which is why we don't like to carry mutual funds in taxable accounts, right? They do an in-kind transfer. And if you want to know more about it, I did a video up here on why ETFs are so tax efficient. But the idea behind this plan is because the Democrats need to find a way to pay for the $3.5 trillion deficit that we have thanks to the Rona monster. Okay, so first thing it says is we're only talking about the taxable accounts of the wealthiest investors, says Wyden in a statement, as the plan exempts ETFs and tax-deferred retirement plans such as 401ks or IRAs. But is this really true? Because here's the thing. It goes on to say, when asked of the industry professionals, they said that roughly 12 million U.S. households own ETFs. The median annual income for these families is $125,000, and 92% make less than the $400,000 a year, according to this plan's idea. So you guys, this is affecting a lot of people, not just the ultra wealthy. Now, I understand that the little guy thinks big guys need to pay more taxes. I get it. I understand. I'm not going to argue that point. But this change would go against President Joe Biden's campaign promise to avoid raising tax on those families with less than $400,000 in income. It could also discourage 33% of millennials and 29% of Gen Zers, which I guess are the after the millennials. I'm not sure. I'm a Gen Xer, so everybody else after me, they're just young, who own ETFs from keeping their money in the market. These are the youngest Americans who are just starting to save today, and they're the ones who are going to be paying these taxes. So is it going to raise money? Sure it will. In fact, the estimates say that over 10 years it could raise $200 billion in taxes. Well, that's great. But is this the way we should be raising it? I don't know, you guys. I decided to look into it and see what some of the larger portfolio managing companies think of it. And they actually asked some of the larger managers who are worried about the impacts of Mr. Biden's proposal on the ETF market. And here's what they had to say. We are opposed to this proposal and have concerns about the negative impact it could have on investors who consider ETFs an important investment option to help meet their future goals. And that was State Street, the people that brought you the spider ETFs, right? So what does BlackRock have to say? BlackRock, is the biggest investing house on planet Earth. The largest ETF manager saw its ETF assets rise 19.2% year over year to $2.67 trillion as of last December. In a statement, the company said, "We would be concerned about policies that would raise costs and reduce returns for long-term investors and retirement savers, and are carefully reviewing Senator Wyden's proposal to better understand how it will impact millions of long-term investors." What does Vanguard say? I'm a Vanguard guy. Spokesman said in an email that the ability of mutual funds and ETFs to transact securities in kind is a long-standing practice that improves outcomes for millions of investors, but added that the manager will refrain from commenting further until additional information about the proposal is released. By the way, Vanguard's ETF assets grew 31.5% year over year to $1.51 trillion last December. So you guys, ETFs are the way of the future. They're a great way to invest. Much like an index fund, the turnover is lower than many actively managed mutual funds. But what this essentially is going to do is make it on par. And so by taking the ability to do in-kind transfers and not make capital gains out of them, it means anytime an ETF is going to sell a security, they're going to have to sell it as cash and then rebuy it. And that is going to show a capital gain. Much like in a mutual fund, you as a shareholder would have to pay those capital gains. Right now, that doesn't happen. And that's why they're so tax efficient, and they're such a good way to hold funds in taxable accounts. Now, you guys, this is only a proposal, and the ETF industry is fighting back hard. And I suspect a lot of rich people who hold ETFs on Wall Street are also going to be fighting it. So I don't know if it's going to go anywhere, but it has the potential to impact 12 million households that currently have ETFs held in taxable accounts. That's a lot of people out there, you guys. What do you guys think? Do you think this is a good idea? Do you think this is a bad idea? Do you think it's going to pass? Let me know what you think in the comments. All right, you guys, I hope you got something out of this. If you did, do me a favor, drop me that like. It really helps the algorithm. If you're not already subscribed, you know the deal. Hit the red button, ring the bell. All right, we'll see you. Thanks.